Hi, Mark again. Today we're going to talk about fear. What if the market changes after I buy? You got to stop trying to predict the market and stress test the deal instead. A lot of new investors are waiting for the perfect market. They say, I'll buy when the rates come down, or I'll buy when the prices drop. Maybe I'll buy when inventory improves, or I'll buy when the economy feels safer. I understand. I see the instinct. Nobody wants to buy at the wrong time. But here's the problem. There's never a perfect time. When rates are low, prices usually run up. And when prices soften, fear goes up. When inventory improves, buyers worry the market is falling. And when the market is hot, buyers worry they're overpaying. There's always something to worry about. That doesn't mean that you ignore the market. You absolutely need to understand it. But new investors get in trouble when they think their job is to perfectly predict the future. Your job is not to predict the future. Your job is to buy something that can survive the future. That's different. Now, a good rental property should not require perfect conditions. It should not require rates to drop. And it shouldn't require immediate appreciation. It shouldn't require rents to jump 20% either. And it should not require refinance in 6 months just so you can breathe. That's not investing. That's depending on rescue. A stronger deal has room. It has room for vacancy, for repairs. It has room for slower appreciation. And it has room for insurance increases or tenant turnover, room for market to be imperfect. That's why stress testing really matters. Before you buy, ask, what if rent is lower than expected? Or what if the property sits vacant for a month or two? What if repairs cost more? What if the taxes go up? What if I can't refinance when I want to? What if I have to hold this property longer than I planned? If the deal still makes sense after those questions, now you may have something worth studying. But if the deal falls apart the minute one assumption changes, you got to be careful. That property may not be an investment. It may be a bet. And betting is not the same as investing. Markets move, rates move, insurance costs go up and down. Well, no, they don't really go down. And buyer demand can move. But the local rules change, and that's just the reality. But a disciplined investor does not need everything to go perfectly. They need the deal to be structured well enough that they can hold up through uncertainty. That's one of the reasons I like long-term thinking in real estate. If you buy a solid property with manageable debt, expect realistic rents and enough reserves, time will become your friend. The mortgage gets paid down, rents probably rise over time, the property may appreciate, your knowledge improves. But none of that helps if you bought a fragile deal on day one. So yes, pay attention to the market, but do not let headlines make all your decisions. Headlines are loud, and math is quieter, and math is usually more useful. Inside the 21-Day Investor, the goal is not to teach you how to predict the future. It's to teach you how to make better decisions in an uncertain market, because that's what real investors actually have to do. Thank you very much. Appreciate your time. We'll see you in the next video.